Hey everyone, it's Ed Kime from over at Quantcha, and welcome to another day of the Quantcha Challenge. As always, we want to remind you to take a look at our unlimited commission-free stock and option trading offer, which is just $99 a month, where you get all our tools and commission-free trading through your Trader brokerage account. So, today what we're going to do is we're going to dig right into a portfolio review and kind of look at our trades and figure out what we're going to do for the day. It's been a down day on the market. As we can see, the S&P is down almost 2% today. We have a lot of stocks, or at least the three that we're covering happen to be stocks that are highly correlated with the S&P. So as expected, those three underlyings are down. Two of our trades were bullish. We unfortunately left ourselves last week in a position with a positive beta weighted delta, so we're taking a bit of a hit on the account. It's not too bad, we're sort of managing our positions and we're making sure. So we are down a little bit. The thing we had hoped for was our bearish position in Exxon would have taken a bigger hit today. It's about keeping pace with the market in terms of the decline. It's really just settling in at that spot where, if we take a look at it, where we're looking towards expiration, if it settles in right here and it doesn't move, we'll make it back. We'll basically make back enough to cover our current down position in the stock. So right now, we're kind of at a break-even spot with this trade. We're hoping for a decline, of course, because we are bearish. We'll see what happens. Our other two positions, we had rolled a Carnival spread last week. If you recall, what we had done is we had set a good till canceled order for a bullish position on Carnival. It filled in the morning on Friday. Then we opened up a new one, which it had the effect of basically rolling out the position up by the strikes by about $2.50. And again, this is 25 days out, so we're looking at 4 weeks at this point. Not too worried about the day-to-day on this. I believe we are in a pretty good position to make some profit on this, just as long as it kind of stays where it is. As a result, you'll notice that because if it were to stay flat here and just kind of eke its way out, we would definitely see a nice gain. That would indicate that we have a positive theta. We talked about theta a while back. In this case, about $1 a day, which would speed up as we got closer to that expiration date. But the other trade we have on here is our Microsoft covered call. We rolled this last week. We're looking at the 106 strike, and right now it dropped. It actually was over 107, broke through 106 this morning, down a little over 105. Microsoft's been a bit volatile for us. We are up on the stock, and we're now up on the option. So in the event that we do see this drop further down, one of the goals we have right here is, because they do announce earnings next week, I don't want to hold the stock through earnings, just because the kind of risk that's associated there, it's not something we were looking to take on for this particular name. So we may monitor this pretty closely and then roll it down if we need to. We are up on that option, that short option here. I think that the plan at this point is, depending on what the market will bear for volatility and for premium, we might roll this down so it's deeper in the money, like to a 105, or if it goes further, maybe to 104, just to kind of get as much cash as we can, and then also just let it assign itself away. On the other hand, what we might do is, maybe we'll just keep it where it's at, collect the rest of this money, and then let the position, close the position out before we go into next week. So that's where we are with these three. There's no real trades we want to make on these three positions today. We're just going to kind of sit back and watch where things are going. I did want to set up a couple new positions today. One of them is that we want to be bearish from what I was looking at. I'm looking at Micron right now, and I think that just based on the direction that it's moving, it's obviously been moving down, but it's also been trending down for a bit. Sorry, the shorter term over the past week. I'm not using a very good example here. Over the longer term, it had trended down a bit. It's not a substantial drop. I mean, obviously it was low when the market was low. It was high when the market was high. But the analyst consensus has been moving downward on it. It definitely does not have the sort of love that a lot of other stocks have right now, even on a down day. And what I kind of like to look for is stocks that are outpacing the loss of the market. So even though the beta is probably over 1 for this stock, it's really the loss is nearly tripling, or about tripling, what the market's doing today. And so The earnings are quite a bit of the way out, so I'm thinking what we'll do is we'll go out to the February time frame. This is the monthly options for February, and we'll just look for a bearish trade against it. And as usual, what I'd like to do is I'd like to take, I'm going to reset our settings here just to walk through this fresh. We have this bearish view that we selected. This happens to be a movement saying that we want to model a price range that goes as low as a 1 volatility loss all the way up to a flat movement relative to the basically a 0 volatility movement, which would account for dividends and interest. But in this case, we're going to budget our usual $500 for the trade, which is a small part of our portfolio, and we're going to stay with the market pricing. Now, the view that we have here is, since I reset everything, it's basically just showing us all the trades and telling us what the best average return would be for that view. Now, the first thing you'll notice is these butterfly trades and condors and stuff. These range-bound trades are great if you are really, really confident about the range of closing. But as you'd expect, if you were to select one of these trades, you'll start to get punished if it goes down too far or if it goes up. So we don't really want the range-bound trades. So if I back up here, I'm just going to check this exclude range-bound trades or strategies, just so we're only seeing trades where, like this bear put spread, if we were to select it and it were to drop further than our view, we'd still continue to profit. That's kind of the goal there. The other thing I have is, even though this particular trade gives us the best average return over the period, I don't like the fact that we can still be right about this view and lose money. So what I'm going to do here is, first thing is I'm going to notch up to use 100 options, but I'm going to change the profile on the option search here so that it does not show us trades that lose money within the view. And the way you do that is you come to minimum return. Among these filters, the minimum return says what's this lowest, what's the floor for the lowest we can accept here. The minimum average is what's the floor for the average we can accept, and then the minimum potential saying I want to see at least this much on the trade. So in this case, we'll go to minimum return of 0, and that's just saying like we just want to see trades where we would gain money in the event that the option or the underlying did not go above its current pricing. And as we can see here, it's trading at 33.72. So it's going to show us a model a little bit above that because of the risk-free interest rate. This is almost a 50-50 trade. We might even be able to find trades where the highest potential is, closer to 100. I'm going to stay with the average return here though, because this will model us a little better. If we click through, we can just take a quick sanity check. We don't want to trade earnings here. Options are liquid, which is nice. We know that we're trading directionally, so we're not worried about the price range being unlikely. It appears likely to be profitable, which is good. So we're more than 50% likely to have a profit here. Unfortunately, we are, as most trades will be, in a fair market, you're going to see a probable return that's negative. And a lot of that probably has to do with liquidity, just because even though these options are liquid, it's using the market pricing, and we're going to give up a little bit as part of doing that. So I'm going to leave this as is, and we could see our view. This was our -1 to 0 volatility movement. This is our bearish view, and then this is the basically the 6-9s view, where we go plus or minus 3 volatilities in our movement and determine. This is kind of like the universe of what's almost guaranteed to happen. 99.73. So we've got some profit opportunity here, I think, just because of our directional view. So I'm willing to take on a trade with a negative average return because I think we're going to be right on our view here. I've got some questions about the profit density diagram, and this simply says if we were to take this profit and loss diagram and we were to look at it relative to the implied distribution that the implied volatility gives us, and we married those two where we said, all right, this is super probable and then there's a gain there and so on, you'd end up with this diagram. And this is mostly useful just to let you know sort of the relative odds and profitability at any given point relative to the others in that chart. The skew looks pretty good right now. I mean, we just want to make sure there's not a big divergence here. So this is sort of a fair trade. We're just kind of betting. We're really just betting on a direction here, and so we don't have a current position in this. So I'm just going to send it to a trade ticket. We're going to see if we can get we're going to ask for 50 cents. Probably not going to be able to get it, but we'll send it for now. We'll send it out there, submit the order, and let that hang for a little bit. Now, if we do get this trade to come in, what I'll do is I'll back up here to the call spread. I'm going to send it to our book to model it in the book against the other holdings that we have. Now, if we were to get this, what we can see is that this change would change our book to give us it would be a slightly better, our delta is still going to be positive here because we're not adding enough negative delta here to offset the full 30 that our portfolio's delta has. So we're still going to be a little bit positive, which I wish we weren't as positive, because right now we want to try to keep that near zero, but it's not too bad. Again, if the market continues to drop, this means that our portfolio is going to continue to drop. But right now, I think we're sort of in a jitter phase where we're going to bounce up and down a little bit. And at some point, the U.S.-China relation should clear up a little bit. It sounds like that could be fairly imminent. And in the event that happens and the government shutdown, there's just a lot of opportunity for positive news to come through that I think will push the market up a bit. So I'm not going to worry too much. I'm happy with us keeping a positive beta-weighted delta at this time. Now, I wanted to address a couple questions that we got over the weekend. The first one that came up was questions about trading the indexes. So, for example, SPX. So if you're using Quantcha with an evaluation account or with a personal account that you license directly from us without linking a brokerage account, then then the indexes aren't available. That's related to the data licensing and the quote licensing requirements. However, if you link your trade to your brokerage account, you will be able to get to SPX. You just punch it in. It won't come down in the drop down, but you can come here and trade it. And or for example, we'll go to the main page, see the options that are available. You'll be able to do directional trades, use the option search, be able to do charting. All that stuff is available, and you'll be able to trade it like anything else. So SPX is available, VIX, and so on. Just to make it clear that that's there. The other thing that came up was a question around actually, let me clear this out just to prove the point here. The other question that came up was around trading calendar trades. And a lot of folks come in and they work with our option search engine. And the search engine is this tool here. This is where you plug in your parameters, you filter and sort, and you get your trade results. And then you can kind of manipulate through here to get through to a trade analysis or what have you. Now, let's say we went to another stock like NVIDIA. Now, I'm bullish on NVIDIA. I think that it being down $9 today is an opportunity for us for a longer-term trade, which I think we might just go ahead and open today. I'm just going to take a look at this. Now, we'll get rid of the pricing here. This is obviously a little bit out of whack that default was set up. So this NVIDIA trade, now when we're in the option search engine and we're looking at this and it's crunching through just a ton of options right now and it's looking at all the different trades and condors and stuff, this takes all of these options that are available, runs them through a few dozen strategies. In this case, we have 41 strategies, and comes up with the best trades based on the view that you give it. However, the option search, which you get to from the dashboard by punching in a search name and clicking through and then selecting an expiration. This is all tied to one specific expiration, which is whatever's up here in this, this drop down, whatever you selected earlier. And as a result, all these trades you'll notice have that expiration for all the options in there. And that is by design to help you optimize a trade for this specific scenario where you're trading a view against this date. Now, we don't support calendar trading in here because, as you can see, we're already up to 80,000 potential trades, and we've already paired the options down here to be more optimal in the way we search and find the trades for you. If we were to add in calendar trades and the ability to do that, what it would do is it would take, for example, in this case, there's over 100 options, and then if we take a look at how they have, a dozen different expirations, there would be, there'd literally be millions of possible trades, including things like asymmetric condors and butterflies that have various different ratios in them and all that. And it would be really, really difficult to just to run that and to find these optimal trades for you. So if you're working with a specific expiration, this is a great tool to find and optimize the trades you're looking for. However, if you want to trade calendars, you want to trade asymmetric stuff, that's all completely available, but you'll want to go directly to the book. So from the drop down here, you can see Manage Book. And the Manage Book, it'll start off with an empty book for you because we don't actually hold anything in this portfolio. But what we can do is we can come down to the bottom and simulate transactions, which will just add them to our pending book. So in this case, I was looking at the Junes for these guys. I was looking at the June 150s, which are about at the money. And right now they're going for 1740. So we can add that in here. And now I have this trade I can see, and if I can move forward using the navigation to find the date. And this is the P&L for that call if we were to buy it at 150 at expiration. However, maybe what I want to do is I want to offset that in a calendar trade. And so I'm going to come back up to, let's say, the 8th, and maybe I want to sell a call at, let's say, 152 and a half. Or maybe I'll go to the option chain and say, let's see what the February 8th look like and the calls, and then come down through here and find the specific trade we want. We could see the moneyness shows us that these, we're looking at the 355, 370 or 465 to buy. If we want to sell these, rather 445 or 355, I can select add, say that I want to sell one of these to offset the other position I was looking at, and then now we have our calendar trade that's in here for analysis. And we can punch back to the current expiration. This is the first one, and now we've got our calendar P&L like we'd expect. Now this blue line is going to be here because that's our current book. We're not holding anything, so there's really nothing to compare it against. That's a flat zero. But we have this current book, which is kind of interesting in that in this case it's statistically likely to return a profit. But of course the weighting of the profit, we could see a big drop that would hurt us a lot. Now, I mentioned earlier that I happen to be bullish on NVIDIA, so I think that this is actually a pretty good trade because what we'd sort of be doing here is we'd be setting up to say we want this long-term at-the-money call, or this 150, and we'd be selling this this call that expires in 2 weeks against it. And the reason that would be useful is that you can see if we can collect 450 against this, let's just say, $18. I mean, that's a quarter of the premium right there. So we would collect a quarter of the premium that we have for this long-term call, and then we could presumably go ahead and roll this over and over again. If we get up to 152 and it actually breaches that strike, well, what we do is we would have some gain here, and hopefully we could roll that up. And then be able to kind of continue to roll these and manage the trade over the long run so that as NVIDIA moved up like we hoped it would, we'd be able to see some gain on it. However, the thing I do want to kind of call out here, which is important, is that NVIDIA's implied volatility is super high. Even in the long run, it's still, for that June expiration, is like 47%. It hasn't historically traded this high. I think that we'll see that the IV rating is high and the IV percentile are high. Rank, rank and percentile. We've got a video that explains the difference between IV rating, IV rank, and IV percentile. I know rank and percentile are super popular and they do serve a purpose, but the thing to worry about is, well, if this is below 50% and this is over 80%, I mean, which one of them do you really follow, and what's the meaning for them? Which is why we added our proprietary IV rating here, and I recommend you check out the video on our YouTube site that talks about the probability volatility will drop from this point over that term. So we're looking at about 80%. So our modeling shows that the IV percentile is a much more useful metric in terms of the current valuation of the implied volatility. But another thing I want to point out here, I just noticed, is we have earnings data and ex-dividend data that we try to incorporate throughout the tools, and we put a lot of effort in to keep this data as accurate as possible because it's so important to option investors. However, it's surprisingly difficult to source quality data for this that's as precise as what we need as options investors. And this is a good example of where our current modeling and our current machine learning and everything else that goes into it is probably wrong a little bit. You'll see we've got earnings here, which would indicate that this expiration is after the earnings announcement, because you can see this is on the left side. If it was centered, they'd be at the same time, but in this case, this would be like the Thursday after hours, the 7th. But if you look at the implied volatility, the height is the following week, which means that almost surely we'll find out, and we'll take a look at this after. But when you see this sort of thing happen, the highest implied volatility in this term, assuming it's all annualized, is going to be the week that is, or the term that's immediately following the earnings. So always just keep an eye out for that, because unless there was some much more massive news event or event of uncertainty that were scheduled to happen after earnings, that highest implied volatility should always be the one immediately following the earnings. So I had been looking at, for example, in the other one we were doing, this the eighth in our book, we were modeling if we were to offset the cost of our long option with the eighth. I would bet if we went back to our book now and we looked at it with the 15th, because volatility is so much higher, it goes from 50 to almost 62, I would bet that we would get even a more substantial amount of our longer term option covered. So I'm going to come back here. We were going to sell the 152.5 for the eighth against our June option. What if we were to sell, in this case, we'll go to the 15th, we'll find that 152.5. If we were to sell this guy instead, yeah, you can see at this point we get almost half the option covered. That's one extra week, which just goes to show how important the earnings are. Now, let's consider this trade for a second here, because what we've kind of figured out, if we move out to that first expiration, what we've kind of figured out here is that we want this long-term trade, which is good because this will cover 2 earnings announcements, and it's going to cost us a lot of money, but it'll cover 2 earnings announcements and give us the opportunity to make a ton of upside in the event that we see a long-term rise in the stock between now and then, the few months out. On the other hand, for this 6-month trade, we're going to offset it by what in this case would be options expiring in 3 expirations, so a little over 3 weeks, and this would be after earnings as well. So the risk that people often have is they'll look at this and they'll say, all right, this 150 call is obviously lower than the 152.5 call, so therefore the intrinsic value of this call will be higher than this call if it's ever in the money. So for example, if it went to 152.5, this call would have 0 intrinsic value, and this call would have $2.50 of intrinsic value, which is true. However, that's not really a guarantee that the money you're going to make is going to exist in the event that the option goes up. Let's say the underlying goes up to 200 by this date. That would actually be really bad for people holding this trade, because as you can see, it starts to drop down here. If it went to 200, we'd be looking at a pretty substantial loss on the trade. And the reason for that is because the change in delta that you're going to see on these trades which is gamma, that's how we measure that, is substantial. It's substantially different. So this trade, as you get up to 152.5, as you get deeper in the money, because it's so much shorter dated, its delta is going to rise much faster and approach 1 than this one will. It will take a lot of upward movement for this option to have a delta approaching 1, which means that once you get to a certain point in the money for this particular trade, or above these calls, what you're going to see is that the amount of money we owe to close this trade out will outpace the amount of money that we've gained in holding this long position. And fortunately, with the tools, we can sort of find out that point happens to be at the 180 terminal price, which is, frankly, from my point of view, I'd be fine doing that. I mean, I think that it's pretty unlikely we'd see a move to 180 from the current pricing, because if we're at 150, what that's kind of saying is, do we expect a 20% rise in NVIDIA between now and after its earnings announcement? If that were to happen, we wouldn't necessarily be in bad shape. I mean, we'd have this call option that's deep in the money, but all the intrinsic value plus all the time value that we would retain and potentially gain for this particular option would be offset by everything we'd have to use to realize the loss in this option. So working with calendar trades, it can be a little complex, and so kind of understanding that that's what we'd be looking at here, and why we might or might not want to make this particular trade. However, for NVIDIA, the bigger thing I'm more concerned about would be the drop. So at this point, we're really only covered. What we'd be doing here by financing our long call with the short call would be putting us in a position where we'd be protecting the downside of this call losing value. If we were guaranteed that the stock was going to go up, obviously we would never bother offsetting this. We would just take our long call, and unless we could precisely figure out that this was going to be a safe strike to be at. But part of the challenge with these calls, especially around earnings, is if you open this trade, it looks pretty good because it says, hey, we're pretty bullish. We'll have a positive delta, but we're not expecting too much movement either way, or we're not allowing for too much movement either way. If we thought there's a high probability of it dropping below here, which in this case is modeled at 30% down here, then that means that we're looking at a 30% chance of losing money on the drop. And that's actually a very dangerous thing for us in a calendar trade, because if we were to lose the money on the drop, the long-term goal of rolling this call somewhere else to make money off of it, to make money to offset this, becomes really, really difficult. Because as this becomes further and further away from the money, selling these calls against it means that you don't want to get to the position where you're going to sell a call that is below the strike here. Because then you run into this big problem where, let's say we got this drop and it fell down here and it was in the 120 range, and we said, uh-oh, we received all the cash from this call, which is great to cut off about half the loss, but we've lost a bunch of money here, and this call is now $30 out of the money. Well, if we go and we try to sell the 152s for, let's say, a week or two later, we're going to get pennies for it. It's just, I mean, it's barely going to be worth it at all. On the other hand, if we say, well, in order to juice out a little bit of return, we go down and we sell the 140s, we might get a buck or two on that per option, depending on how far out we went. But what we're also saying at that point is we're just in damage control, because we're still waiting for it to start to surge back upward. And the last thing we'd want is for it to actually recover to 150 or higher in that brief time frame, because then we'd be short 140s. This call, the underlying would rise up. This would gain back some value. Of course, its delta would be below 50 because it's out of the money. But then this 140 we would roll into it would have a ton of realized loss that we'd have to take when we closed out that option. So I know this is a bit of a long walk through it, but as much as I like this long-term calendar trade, we're probably not going to open it today, partly because I don't want to add more delta to our book. We can see that our our delta is still kind of hanging out a little bit higher than we want it to be, around that 30. I don't know if our trade is filled yet. Let's go and take a look at our orders, see where we are. All right, Micron's not filled yet. It's 48 still. I'm going to see if we can zero in on it. We'll let that sit at the midpoint for a few seconds and see if we can close it out. But for now, this is all we're going to do for the rest of our call today. We'll try to get some kind of error, it looks like, on the server. So let's try this one more time. We're going to see if we can. Oh, we are filled in at that 48. We're not going to cancel the order. We're going to cancel the change. We'll let that sit for a second, and we'll start to punch up. So we'll see if we can get 47 cents. And yeah, it's unfortunate that we went for that Starbucks trade a couple weeks ago. We needed the delta hedging at the time. That my biggest regret for that particular trade is that we did not. My biggest regret for that trade at the time, and we see we filled here at 47, was that we didn't put it for a longer period. Although, to be honest, if you look at Starbucks today, with everything else down, it is up. So go figure. And that actually brings up a good thing I wanted to point out was, let's take a look at. I'd mentioned that our Carnival trade we had rolled it. So if we take a look at the position here, we can see this is the position we're in now, as indicated by the position still held icon. If I expand this out here, we can see we were in this. We opened the trade. We rolled out of these options. We rolled into these options. These happened as separate transactions that day. You can see we actually bought to close the 52.5s, and then later on in the day we came back and we sold. We bought to open the 52.5s because we were hedging against selling these 55s, and that's what we hold today. And we can see the current. We're down a little bit on that roll trade, but it's pretty cool to be able to check that stuff out. But I wanted to talk about Starbucks briefly, and it comes up as two different trades right now. We can see that right now it misidentifies these as being expired. They didn't actually expire. What happened was we bought and sold, and right now it doesn't. It's not wired up. I guess it's too close to the transactions for those to trigger properly. But effectively, I had been asked what would happen if you let a fully in the money trade expire that was a spread, and this is basically what happens. You can see we had these 63s that we were long, so I'm sorry, we had these 63s we were short, so we had to go out and we had to buy that, and then at the same time we were long these, and so we were able to exercise those to be able to offset. Long story short was it bought the ones we were long, or it exercised the ones we were long. It let us get assigned the ones we were short, and we have this net 869. But we had received a credit of 422 to open it, so we lost about 450 on the trade plus the transaction costs of the assignment. So it was a bummer that happened. It did hedge us on the downside, but you know, as investors, we always want to sit around and look and say, oh, if only we hadn't made that trade. You know, you sit there and you wish that the market did move against you or whatever it was. But that's one of the great things about our analysis tools is if we go to current quarter, and I will enable everything, we can basically follow all the trades that we've had and things that we have open right now and see, you know, we made a few bucks on the Johnson & Johnson trade. We're up a bit on the Carnival trade. We're down a little bit on Exxon. We're up on Microsoft. And we can see kind of how we've been performing against the portfolio or against the market or what have you to get a net return to this point. So anyway, I'm going to leave it at that. Our current book is what it is. Everything's kind of down on the day. We have this delta that's close to zero, which I'm actually pretty happy about that we've made that trade. And then we have a gamma that's negative. Doesn't really hurt us too much. These, you know, if we can keep these things in single digits, I'm happy. And of course, we have a theta that's above zero, which means that our entire portfolio is currently set up where we're going to gain money, as you can see on each of our positions. If we can just stay exactly where we are, we're in a position to profit on every one of the trades. So we'll kind of leave it there for the day, and check back in tomorrow and see if maybe NVIDIA is in a better position for us to move on. But anyway, wrapping it up, hope everyone's making the most of this down day. And if you have any questions, please head us up at hello@quantcha.com or leave a comment below. And as always, good luck and good hunting.